Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Mark Marex, Director of Index Research and Development at Nasdaq Investment Intelligence, for an update on technicals in the Nasdaq-100. We'll take a look at RSI, short and long-term moving averages, as well as options positioning and volatility. Mark, it's great to see you as always. Welcome back to Trade Talks, and certainly an opportune time as we start to head into month end to look at Nasdaq-100 technicals. Let's kick it off. Let's take a look at RSI.
Thanks, Jill. Great to be with you as always. And yeah, let's take a look at the relative strength index, the RSI for the Nasdaq-100, the NDX. The basic things to know here is the green line that I've highlighted, that's a level of 70. Anything over that, when you see that dashed gray line kind of popping up over the green line, that means the market sentiment has gotten fairly bullish, almost overly bullish, you would expect to say. And possibly subject to a short-term correction in the near term. And then that red line, anything underneath that or touching that is kind of getting to be overly bullish. Anything in the middle is kind of, not too bullish, not too bearish. Level of 50 is neutral. So you can see here with the blue line, the NDX, as it has cooled off recently, at times on a day like today, it's felt like the second half of the year has been kind of rougher than it actually has been. We're only down about, looks like 3.5, maybe a little bit more than that % so far since the end of the midpoint of the year. But we've been kind of oscillating down, then back up, then down, then back up. You see that for the most part, that RSI indicator has been wobbling between the green and the red, sometimes approaching the red there, getting a little bit more bearish recently, but nothing sort of out of the ordinary. I've highlighted some of the last couple of times that we've touched the red there or exceeded the green. It's been a fairly orderly, prolonged, longer term correction down here as we kind of get towards that 5% correction level. And so far, not anything too dramatic in terms of the swings back and forth. And you'll see that later when we get to the volatility.
Well, let's take a look at the short-term moving averages.
Yeah, so this is 20-day in the gray, 50-day in the red, the price of the index again in the blue there. And you can see the 50-day that I've highlighted there, that level is 15,041. That has crossed above the 20-day. The 20-day is lower than that at 14,874. Right as I'm talking to you, we're at 14,610 after a day where we're down close to 175 points on the index. So we're currently sitting sort of right around those areas of support, a little bit below. We've been wobbling kind of below, back above, below, then back above. That is definitely signaling to me, to us, that we are not in sort of a pronounced downward bear market trend yet. The market is seemingly sort of, from a technical perspective, trying to consolidate around these moving averages, whether it's kind of closer to the level of 14.7, 14.8, 14.9, hard to tell in the short term, but we haven't sort of, I would say, convincingly, right, broken below where the short-term averages kind of indicate this near-term support, at least not yet.
Right. And then, Mark, if we take a look at the longer-term moving averages, does that suggest a different story, or is it within line?
Yeah, I mean, the 100-day, the red, you can see kind of similar recently. We've dipped below, we've dipped back above, we've kind of hugged the 100-day as well. The 200-day in the gray, we're still well above that, right? The support there is around 14,000. So that's a significant kind of drop below where we are right now. Another, call it, 4 to 5% below where we are now. So that's sort of, medium to longer term where you would look for support in the index if there were to be, a really bad breakout of geopolitical news, obviously with stuff going on in the Middle East and in Ukraine still, a bad wave of macro news, whether it's inflation, whether it's long-term rates continuing to go up. That's sort of the area of support that I would look out for, around 14K in the longer term. Right now, for now, we are playing around. We are kind of hugging those shorter term areas of support right in that sort of 14.7 to 15,000 range.
All right. And finally, let's go back to your earlier point on options positioning and volatility.
Yeah, so if you look at the broad market, right, on the left-hand side, SIBO's got their, equity put call ratio. I'm showing a 1-week rolling average here. This measures the total ratio of puts to calls for the entire US equity market. And the line I've outlined there in the purple, that's the 0.7. That's typically what people denote as the crossover between overly bearish, anything above a ratio of 0.7 calls for every, 0.7 puts for every call outstanding. That means a lot of people are positioning for downside, right? But buying up their put activity. You can see heading into this year, right at year end 2022 was that massive spike in the ratio to 1.5. That didn't really end up meaning all that much, right? Investors were positioned for some turbulence heading into January of this year. It was one of the most, biggest kind of over positionings of puts that we've seen historically. Didn't end up really being an indicator of anything because we were off to the races in January. Recently, we have jumped back up above 0.7, as you can see, even above 0.8, approaching 0.9, and we've kind of stayed there, right? We've stayed above that 0.7 range for several weeks now. That kind of tells you that, this is a little different from year-end 2022. These are investors that are kind of continually positioning themselves to be a little bit more defensive, probably related to a lot of the negative headlines we've seen from a geopolitical perspective recently. And then on the right-hand side, you've got the index volatility. This is the SIBO NDX volatility index, the ticker VXN. What I've outlined here in the purple is a level of 40, and sort of circled a few times in the last few years that we've breached that level post-pandemic. There were a couple spikes in volatility, but we've been on a pretty nice downward trend for most of the end of 2022, most of 2023. Recently, a bit of a tick up. We're kind of nearing back towards 25 as opposed to hovering around 20. So it's been this kind of, I would say it's been an orderly increase in defensiveness, in a sense of risk re-entering the market after just an absolutely stellar first half. Best first half in the history of the index going back 38 years. And that's probably not too big of a surprise, right? Investors want to lock in a lot of those gains that they saw in the first half of the year. The news flow hasn't been particularly great from a kind of big macro news perspective this quarter. And so you're seeing that inch up in the puts positioning, in the volatility of the index, and you're seeing some risk taken off on down days like today. But so far, pretty orderly, and hopefully, this is just taking some air out of the sails of an extraordinary rally throughout most of this year and setting us up for a better conclusion as we head towards the end of the year.
All right, Mark, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.